Hello viewers, welcome to Watch Invest Grow. In this video, we will discuss about some of the important stock market terms that you have to consider before buying any stock. Most of the investors do not know these terms while entering into the stock market. Understanding these terms will help you to make less mistakes with your stock investments. Let's get started. We are going to discuss about the following key market terms in this video. Things to consider before buying stocks: market capitalization, earning per share, profit to earning ratio, industry profit to earning ratio, dividend yield, 52-week high and 52-week low, shareholding, quarterly and annual results, peer, sectors. Market capitalization. It is the total value of a publicly traded company's shares. It is obtained by multiplying the total number of outstanding shares by the current price of a single share. Example, if a company has total of 10,000 outstanding shares and the market price of a share is 10 rupees, then the market capitalization of the company is 1 lakh rupees. When a company decided to enter into the stock market, they hire an investment bank to decide the initial price of a share and share count. They use various strategies to finalize these numbers. They ensure that shares are priced reasonable. Companies can be categorized into three types based on market capitalization: large cap 20,000 crore or above, mid cap 5,000 crore to less than 20,000 crore, low cap less than 5,000 crore. Low cap companies are more risky and mid cap companies are moderate risky and large cap companies are less risky. If you are a low risk taker, you can go for large cap stocks as it doesn't fluctuate more. Good low cap stocks could give you great returns, but don't invest in low cap stocks if you don't have good knowledge about the company's business, financial reports and growth projection. Make sure you check the company's market capitalization before buying any stocks. Earning per share. It gives investor an idea about the profitability of a company. EPS is calculated by dividing the company's net income with its total number of outstanding shares. Companies that have good EPS growth over the past years should be a good candidate for buying. Profit to earning ratio. This is the most important factor to consider before buying any stock. The value investors identify good multi-bagger stocks based on this ratio. It is obtained by dividing the current market price of a single share by EPS. The lower the PE, the higher the chance of share price growth. The average PE of Nifty 50 stock is 20. If you see company with PE less than 20, that will have good chance of giving more returns. Companies with PE more than 20 are considered to be overpriced stock. However, PE should be looked and compared on the stocks on the same sector. Most of the FMCG stocks has a history of PE greater than 50, which doesn't mean you cannot buy them, as the investors believe that FMCG sectors will give good returns at any situation. It always have higher PE. We consider it is good value stock if the PE is below 25. Industry profit to earning ratio. It tells us the average PE of the stocks in the same sector. It gives an idea of how much the investors are interested towards a sector and the average PE of a company in the sector. If you decided to buy a company, just compare the company's PE with the industry's PE, and if the company's PE is less than the industry's PE, then definitely it is a good value buy. Dividend yield. Dividend is kind of a bonus that company provides its shareholders directly to their bank account. On an average, you may get 0.25 to 0.5% annually as a dividend. We can refer the dividend yield value just to understand how much money the company will pay us per annum. However, we shouldn't buy stock just because they provide more dividend. Companies that provides more dividend does not typically show good growth in share price. 52-week high and 52-week low. As the name suggests, the 52-week high is the highest price of a share over past 1 year, and 52-week low is the lowest price of a share in the past 1 year. If you see a stock on its 52-week high, it means that company is doing good business and it is attracting the buyers. On the other hand, if you see a company on its 52-week low, it means something is seriously wrong with the company and it is better to avoid buying shares on 52-week low. We have heard people saying they don't buy stocks when it is at peak price and they wait for a dip to buy stocks. You don't actually need to wait for a dip to buy stocks. There is nothing like a good time to buy good stocks. If you find some good stocks at dips, that is well and good. Just buy those. But don't wait for a dip for buying a good stock. Shareholding. It tells us the percentage of a company's shares being held by the promoters, domestic institutional investors, foreign institutional investors, and general public. Shareholding history tells you whether the parties are interested in buying the shares of a company or reducing the holding in a company. If the institutional investors' holding has been constant or increasing gradually, it means they are willing to hold or accumulate the stocks. If you see the numbers decreasing, then it is better to avoid the stock. Results. Companies post their audited profit or loss for every quarter, which is called as the quarterly result. Annual result is a consolidation of the 4 quarterly results. The performance of a company in the recent years is important, so don't look at the financial results beyond 5 years. If your profit of a company grew by 2 times in the past 5 years, it is a good buy. Make sure the company's sales and profit are rising consistently in the past 5 years. Peers. As the name suggests, peers are the competitors in the same sector. Before buying a stock, just compare how the competitor is performing on the same sector. Sectors. Indian Stock Exchange has stocks from different sectors. Major sectors are FMCG, automobile, metals, IT, banking and finance, cement, chemicals, pharma, paints, consumer durables, etc. It is good idea to consider buying the top stocks on the sector based on the market capitalization and financial results. We don't need to think about touching all the sectors. There may be good time and bad time for the different sectors. Pharma stocks have been on downtrend for the past years due to the rise in price in the international markets, and cement and tire companies faced a dull business due to the rise in the price of raw materials. FMCG, banking and finance have been a good bet for investors over the years. So try to have a good allocation of money in these sectors. Hope we have covered key terminologies in share market. Take those into consideration before buying a stock. Thanks for watching our video. If you like our video, please do like, share, subscribe to our channel and hit the bell icon to get instant updates. We will meet you soon again with our next video. Thank you once again. Happy investing.